Welcome, everybody. Hope you're having a good Wednesday. We got Jim Black with us. What's up, Jim?
Good morning, everybody. Thanks for having me on. Excited to be on Lab Coat Agents with my good friend Tristan Ahumada. So thank you.
Tristan here. So we're going to be doing this weekly where we're going to be doing our best to give you the latest on what's happening in the real estate and mortgage world. Jim is a pro on the mortgage side, and I'm a pro on the real estate side. I'm learning from Jim all the time. So we're going to pick topics that we think are crucial or important that indicate how things are changing and where things are going. The thing that's in our site today is the housing affordability bill. And I'm going to give you a rundown here, and I don't want to screw it up, so I'm just going to read what I've got here for you. You ready, Jim?
Fire away, my friend.
All right, here's what I got. Key details. Congressional votes. The House passed the bill 358 to 32 on Tuesday night, following a 85-5 Senate vote. They don't ever agree on anything. I'm just surprised they agreed on something. This is crazy, okay? 85-5. I want to know who the five were that didn't do it, but forget it. Uh, Primary goal, the bill contains 45 provisions aimed at cutting red tape, reducing permitting review times, and encouraging new home construction to tackle a structural national shortage of roughly 4 million homes. I love the red tape part. I don't know the details. I know that here in Los Angeles, Ventura County, Malibu, there's a lot of red tape, dude. We can't build anything practically. It's tough. And so the fact that the federal government says, hey, we're going to do it could be something good that shows the states should be doing it. Institutional buyer ban. I won't go into details on that. Banking deregulation. And to me, this is where I go to you, Jim, but banking deregulation always sounds terrible as a phrase. So I'm going to see what that means. And then one of the things that we noticed yesterday is that the companies that were buying buy what is it, the houses to rent, they weren't going to be forced to sell those if they currently own them, which was really nice. But dude, that kind of all went to hell this morning because Trump's not signing it. He's saying, hey, wait, this is great. I'm glad you all agree on something, but I'm not signing it until everyone agrees to sign this thing called the Save America Act, which in essence just means you need documentation to vote. And I'm like,
Sadly, yeah,
dude,
sadly, affordability should not be tied to politics. It's simply a way of living. That's all that matters. If you can't afford to live here, you're not going to be able to vote anyway. So what's the point? It's like it's just all this extra political stuff. I won't get into politics, but I will
I
get into the
will.
fact the
It's a bunch of
the part
shit,
you
dude.
brought.
Come on.
It
You
is.
can't
It's not
hold
good.
something hostage like that.
It's not good.
It's a
It's not
terrible
good.
move. It feels like I'm watching an episode of Game of Thrones, dumbed down a little bit, but you know, no dragons sucks. But we do see the different houses. All right, let's talk rates because last week you and I talked mortgage rates. We thought, yay, the war's over. I don't know why I thought that. I'm an idiot. Okay. But it's not quite
So rates.
over.
So rates, right?
It,
We know oil.
I don't even know what the hell's going on. Mortgage rates, what should we expect?
So rates are starting to go lower. They're lagging. They're lagging from the oil prices because of with inflation. So what you're seeing is rates are starting to go lower, but they're hovering around 4.4 to 4.5 on the 10-year Treasury. That historically means that rates will support about a mid to low six range. And you have to
Hmm.
think about this. Banks are in the business, or mortgage companies are in the business to make money off interest. So just because the Treasury is at 4.5% does not mean rates are going to be there.
Got
Banks
it.
and lenders need to make a margin on the money that they lend out. So we'd love to see rates go below 6%, but it's going to depend on some of the factors of the economy. Where the economy is doing very well right now. There's talk about the Treasury, the new Fed president talking about Reserve president thinking about keeping rates higher or maybe even raising them. So what ends up happening is
Hmm.
investors are more hesitant to drive those rates lower if they think rates are going to go higher in other categories. So normally oil means inflation goes down. Normally inflation means treasury yields go down. But unfortunately, right now it's a little bit stubborn with is this a real ending to this situation as you talked about earlier?
Yeah, and I think the uncertainty is really what causes the problem for all markets, not only on our side with buyers and sellers, but on your end with the same audience. It's like, well, wait a second. I don't know where the real estate market's going, but I don't even know where the rates are going. Are they going to drop? Should we wait? Maybe we should wait until this thing subsides because here's what I've got for mortgage rates. And I always go to Mortgage News
Yep.
Daily.
It's a good resource. It's a good litmus test. It's not exactly accurate. Every market's different. Every
Yep.
mortgage company and product are different. But yes, this is a good place to start. Here's what's interesting to me, Tristan. In the
Tell
last
me.
24 hours, I'll give you two examples of what I'm seeing across the country. In Austin, Texas, I'm licensed in multiple states, but in Austin, Texas, we can't get a single buyer to write an offer on a $350,000 home. In Portola Valley, Silicon Valley, California, Northern California, Palo Alto, that area, I have a multiple offer counter situation at $8 million. It's just mind blowing to me that affordability is the name of the game, and it's just a supply and demand issue. It's a haves and have nots. It's really a skewed marketplace where the psychology in the local markets are uncertain, but you would assume that a first-time home buyer would be able to afford a $350,000 property in Austin, Texas, but there's not even
Mhm.
more than one offer on that. And then at $8 million, you have multiple people bidding it up in the Bay Area, California. It's crazy. It doesn't make a whole lot of sense. So until we get confidence back, until we get people to have a consistent long-term strategy around doing something in real estate, we're going to have these markets
Mhm.
that are really spotty. And we know inventory is light too, right? Inventory is light in most markets also because people aren't willing to move. If rates are 3.5% on the current mortgage, every time rates
True.
go higher, it's one less reason not to make the move and maybe move down or move up.
Well, that's why this is a surprise to me. Like mortgage applications rise 1% as rates hold. That's like we just saw 6.6, right? It's the same. What do you think is the reason for this? Is it just seasonal, specifically because it's summer, everyone's on break? They're like, well, the rates aren't too bad. Well, tell me. I don't understand.
I think it's seasonal for two factors. One, you have empty nesters or seniors that are looking to make a move closer to their family, downsize. There's more properties on the market. They want to move and sell their property. And the second one I would say is families wanting to get into a property so that their kids are in good schools. So you see that trend right now for people to get in before the end of August to whatever school district they're going to be in or whatever housing situation they need to be in. If you have kids, the last thing you want to do is move during the school year. So I think those are seasonal elements that you're starting to see. And again, too, you just have some seasonality with just living areas, right? There's some areas that are finally having snow melt and they're now able to sell and move homes a lot faster because people are looking more at those properties. So I think it's seasonality for sure. Um,
Hmm.
I'm happy to see it didn't drop down 15 or 20%. So you have
That's
to
true.
realize people that are starting to look in the last 6 months don't know any difference in interest rates. They've only seen the sixes. It's those buyers that looked 3 or 4 years ago that might be on the fence still
Yeah,
because they could have got a rate of 3.5%.
that's
There's one
true.
more anomaly that's happening too with new construction. It's really important to follow this, and maybe we can do a follow
Okay.
up on this. A lot of builders subsidize rates to get people into homes the last 5 years. They did a buy down, or they did a 2-1 buy down, or something in regards of giving someone a lower temporary rate adjustment. Well, guess what?
Okay.
Those adjustments have gone higher now. So you're starting to see new inventory compete with new inventory of people that can no longer afford their payment shock, even though they qualified 2, 3, 4 years ago for that higher payment. They're finding that that difference in where they are today versus the new adjusted payment is too much. So they're starting to sell those properties. So builders
Dude,
have properties they're competing with in their own projects.
well, see, that's something we called out. I don't know. The moment we saw it, I was like, that's bad news. That feels like 2008, just a little different, right? And so I'm concerned in those areas where we're watching that happen, but we're also watching a more depressed market. Because if I bought 2 years ago and the prices are lower, and I put 20% down, dude, I just lost my 20% maybe, right? And now what? That's a
Yep.
big problem.
Big
So,
problem, big problem. And NAR, by the way, does not track one key data point that I think is important. Credits. We talk about list price and sales price, but no one talks about the credits in a transaction. I have a feeling on average it's about 2.5 to 3% are the credits being offered to a buyer, not to lower the price, but to subsidize the cost to buy or acquire a property. And that key data point is not tracked. I think if that data point got tracked, it would be eye-opening to see what the actual difference in depreciation is, if that makes sense.
all right, hold on, because I track,
Maybe you have
I have
that.
this really cool tracker, right? So let's go through the things I track daily, thanks to AI. Thank you, AI. We've got the affordability index, which has been pretty stable lately, but there was one on, you were talking about new construction, and I know I track that. So here's the builder confidence. It's still low, by the way. Anything under 50 is low. So I'm surprised that it went slightly higher. But building permits is something we look at. I mean, you guys are building something up in Wisconsin, right?
Yes, yes,
Typically, these are the three, let me make sure. Yeah. These are the three right here that we look at for new construction. Look at the amount of months in new construction supply, dude. That's high
very high. And I'd like
in
to, yeah,
comparison
I'd
to
like to
this
see
one.
it totally. And I'd like to see is that from when they put the shovel in the ground or when the house is completed in terms of resale? That would be
Ooh,
interesting, 5%.
that's a good question, man. I don't know. I'm going to find out for you. And then housing starts is important. This one's as of May 2026. It's down significantly. So that means at some point in the future, we're not going to be building enough, which wasn't that just the problem we were talking about at the beginning? Like all of the
Exactly.
red tape?
Exactly. And that would be a good sign if builders agreed that these affordability acts would make a difference. You'd probably see that number be green versus red,
Yes, very
right? Because
true.
they would get in front of it. They would get in front of it to trim off some of the duration of time to be able to get those properties on the market. So there are a lot of it's very polarizing right now. We have a lot of people that believe something positive is going to happen and others that think something negative is going to happen. And we know it's specific to your neighborhood, right? If you're a realtor,
Yeah,
it's specific to your neighborhood. If you're a buyer, you're looking at a specific zip code or address. So we just know that that's important to think about. So it is a very interesting time. But yeah, those new housing starts is a little bit of a red flag because it takes 1, 2, 3 years to get those permits completed to even start building. So the fact that we
that's
have a
true.
lag now means that it will probably be a couple years down the road before we see that inventory come on.
Agreed. All right, let's talk two more things really quick because we got a little bit of time. 5 minutes. 10-year Treasury yield, unemployment. We're looking at the 10-year Treasury has obviously shot up since COVID, but if we're looking at just more recent, since February, what the hell happened here, man?
Oil, baby. Oil prices. That's
Oil,
everything. Yeah.
baby. I like that.
Oil. Yep.
Hold on,
Yeah,
hold
it's a
on.
straight oil.
Let's
Yeah.
let's grab the oil because I think we did this earlier. Where's the crude oil? Here's the crude oil. Let's compare both. So, yeah, look at that curve that you just said. Same thing. Now, oil has come down recently. Does it take it a while? Is oil
It
coming
does.
down now? What happens?
Yeah. So look at that. Look at the blue line versus the green line right there. It's a lagging indicator. Do you see that
Yeah, I
10-year
see what you're saying.
treasury kind of reacted? Now look at it too. It will react the other way, but it'll be lagging. So rates will adjust.
Oh, I
Uh,
see what you're saying. It finally comes down. I see. Look at this. Let me do a
always
5 year.
lagging in your charts. It looks
Oh,
like it's
you're so
lagging.
right. Okay. Slightly
So I think we'll
lagging.
see rates. Yeah, I think rates in the next couple
Interesting.
months will go down. And we are seeing rates. There are rates available below 6% if you pay some money. When we think about those solutions, we ask the consumer or borrower, "Hey, what's the break even of your cost versus value to buy the rate lower?" So I had a borrower 2 days ago wanted to get the rate down to 5.99. It's going to cost them $25,000, and their goal is to pay off the loan in 3 years. So I told
Hmm.
him, I said, listen, that's not a smart move. Like, do not just waste money because if rates go lower, you've wasted $25,000. Or the duration of the cost to buy that rate versus a savings is like 10 years. So it doesn't meet your time horizon. You're going to pay it off in 3 years. Why would you want
True.
to spend money to try to save money in 10 years? So just talking to local professionals, if you're an agent, a lender, trusted CPA, financial planner, whatever it might be there of value when a client needs your help and support. Give them the tools to make the decision, empower them to make it be their decision. That's my goal every day. Provide the data, the tools, the solutions, and have the borrower be part of the journey and process with the agent. So
I agree with you. Give me one more thing. Foreclosure starts. This is March, so I think the April data is already out, but I only have until March. In comparison to 2008 and 10, it's super low, right? But dude, look what happens if I go 5 years. Like, should I be worried now? I mean, when we look at it like this, I'm like, don't be worried. But when I look at it like this, I'm like, what the hell is going on? 5 years?
I've
What's
heard
going
it.
on?
I've started to hear rumblings of short sales across California specifically. I've heard the fact that newer agents don't know about that experience. So everyone's relearning how to negotiate a short sale with a bank. I'm starting to hear that more and more. Not that it necessarily has to happen, but it's a smart
No, but
conversation.
yeah,
Especially if
I
you're an
agree.
agent, you get paid for your efforts. You got to make sure on a short sale, you're actually going to get paid because a short sale means basically a borrower doesn't have the ability to pay off the note that's owed. So it's up to the bank's discretion who gets paid what. So really understanding short sales, I think would be an important topic to cover just so people understand
Hmm.
if you're close to taking on a listing, be prepared for that short sale conversation because
You know,
a foreclosure takes 36 different times. If you have an owner occupied foreclosure property, the borrower has to be talked to, communicate with like 36 times. Modifications have to be offered. So that foreclosure data, I think, is going to be lagging also. But there are short sale conversations happening every day right now. You buy your house, someone bought a house in the last 5 years, there could be a chance if they're in a certain market that they might be upside down or at least at a break even.
I agree, which we talked about with the new construction too. All right, Jim, let's wrap up. Dude, this is awesome. I
Thank
love
you,
that
buddy.
we're going a little longer too and going deeper into
I love it.
this. So
Thank
let's
you
see
again
what
for having me
happens.
on. Yeah, love you, buddy. And I appreciate being on. You have the best audience, the best followers, the best content. So I'm honored to be on here. You could have chosen one of 48,000 other loan officers, and I'm honored to be your partner in this. So thank you so much, and have a great
You're
Wednesday,
the
everybody.
first one I
Appreciate
think of, dude. Come on.
it. That's
I'm a
scary.
Jim Black. Thanks, buddy.
Thank you,
Appreciate
guys.
you. Thank you.